Index funds versus mutual funds versus hedge funds versus ETFs. Navigating the world of investing can feel daunting with so many options, like index funds, mutual funds, hedge funds, and ETFs. Each has unique features, costs, and risks, making them suited to different financial goals and risk tolerances. This video breaks down what each is, how they work, their pros and cons, and who they're best for, whether you're starting with $100 or managing millions. Understanding these vehicles will empower you to make smarter investment choices. Let's dive into the details. Please subscribe to support our work, like, comment, and share. It will make a big difference with the YouTube algorithm. And check out our courses on Udemy, like IT Support Quiz Course, link in the video description. Thank you. But first of all, I would like to make clear that this is not any kind of financial advice. Number 1. Index funds. What they are. Index funds are a type of mutual fund, or ETF, that tracks a specific market index, like the S&P 500, by holding all or a representative sample of its securities. They aim to match the index's performance, not beat it. How they work. Passively managed index funds replicate an index. Vanguard S&P 500 Index Fund, VFINX, with minimum trading, keeps costs low. In 2025, the S&P 500 averages 8 to 10% annual returns before 2 to 3% inflation. Costs. Low expense ratios, 0.04% for VFINX, a $10,000 investment incurs $4 a year in fees. Pros, low fees, minimize cost drag on returns, diversification, exposed to hundreds of stocks, 500 and S&P 500. Predictable, match market performance, ideal for long-term investors. Cons, no outperformance, can't beat the market. Market risk, falls with the index, 18% S&P 500 drop in 2022. Best for beginners, long-term investors, retirement savers. Example, a college student invests $100 a month in VFINX via a Roth IRA, growing to $92,000 in 30 years at 8%. Example, I invested $5,000 in VFINX in 2024, earning $400, 8% by mid-2025, with only $2 in fees. Number 2. Mutual funds. What they are. Pooled investments managed by professionals who pick stocks, bonds, or other assets to achieve specific goals. Growth, income. Can be active or passive. Index funds are a subset. How they work. Actively managed funds, Fidelity Contra Fund, FCNTX, aim to outperform benchmarks through research and trading. In 2025, active funds face pressure from low-cost ETFs. Costs. Higher expense ratios, 0.5 to 2%, 0.85% for FCNTX. A $10,000 investment costs $85 a year. Some charge load fees, 3 to 5% upfront or on withdrawal. Pros. Potential to outperform. Skilled managers may beat the market. Professional management, ideal for hands-off investors. Variety. Options for growth, income, or sector-specific funds. Cons. High fees, erode returns, especially if underperforming. Inconsistent performance. Only 20% of active funds beat the S&P 500 over 10 years. Tax inefficiency. Frequent trading triggers capital gains taxes. Best for investors seeking active management or niche strategies, small cap funds. Example, a retiree allocates $20,000 to a bond mutual fund for steady income. Example, I invested $10,000 in FCNTX, earning 10%, $1,000 in 2024, but paying $85 in fees versus $4 for an index fund. Number 3. Hedge funds. What they are. private investment funds for accredited investors, $200,000 plus income, or $1 million net worth, using complex strategies like short selling, leverage, or derivatives to maximize returns. How they work: actively managed with flexibility to invest in anything, stocks, crypto, real estate. In 2025, hedge funds like Bridgewater use AI-driven strategies, but face scrutiny for high fees. Costs: high fees, 2 and 20 model, 2% management fee, 20% of profits. A $1 million investment costs $20,000 a year, plus 20% of gains. Minimum investments are often $100,000 to $1 million. Pros: potential high returns, may outperform in volatile markets. Diversified strategies: hedge against downturns, i.e., shorting stocks. Exclusive access, sophisticated tools for wealthy clients. Cons: high fees, significantly reduce net returns. High risk, leverage amplifies losses. 2008 hedge fund collapses. Liquidity: funds often lock up capital for months or years. Best for high net worth investors comfortable with risk and liquidity. Example: a CEO allocates $500,000 to a hedge fund targeting 15% returns. Example: a client's $1 million hedge fund investment gained 12%, $120,000 in 2024, but paid $44,000 in fees, 2% plus 20% of gains, netting $76,000. Number 4. ETFs, exchange-traded funds. What they are: funds traded on stock exchange like stocks, tracking indices, sectors, or assets. SPY for S&P 500, IBIT for Bitcoin. Can be passive or active. How they work: ETFs combine mutual fund diversification with stock-like trading flexibility. In 2025, Bitcoin ETFs, IBIT, and ESG ETFs are surging, with $138 billion in crypto ETF assets. Costs: low expense ratios, 0.03 to 0.5%, 0.09% for SPY. A $10,000 investment costs $9 a year. No load fees, but trading fees apply, $0 to $5 a trade. Pros: low fees comparable to index funds. Flexibility: trade anytime during market hours. Variety: from broad markets to niches like AI or crypto. Cons: trading costs. Frequent trading can add up. Volatility: niche ETFs, crypto can swing 20 to 30%. Complexity: active ETFs may confuse beginners. Best for investors seeking flexibility or niche exposure. Tech, crypto. Example: a young professional buys $5,000 in SPY for long-term growth. Example: I invested $5,000 in IBIT, Bitcoin ETF in 2024, gaining 20%, $1,000 by mid-2025, but faced a 10% dip during a June correction. Practical tips for choosing. Beginners: start with index funds or ETFs, VTI, SPY, for low cost and diversification. Invest $100 a month in a Roth IRA for long-term growth. Moderate investors: consider mutual funds for niche strategy, small cap growth, but check fees and performance history. High net worth: explore hedge funds if you're an accredited investor, but ensure liquidity and risk align with goals. Diversify: mix index funds, ETFs for core holdings, and mutual funds for targeted exposure. Avoid over-allocating to volatile ETFs like crypto. Tools: use Yandex Finance to compare fees and performance. Critical perspective: the hype around ETFs, especially crypto ETFs in 2025, can overshadow risks like volatility, Bitcoin's 10% June dip. Hedge funds promise high returns, but often underperform after fees. Only 10% beat the S&P 500 long term. Mutual funds' active management rarely justifies costs, with 80% failing to outperform index funds over a decade. Ex post tout ETFs for their flexibility, but frequent trading can rack up costs. Index funds remain the safest bet for most, balancing cost and performance. So index funds, mutual funds, hedge funds, and ETFs each serve unique purposes. Index funds and ETFs are ideal for low-cost, diversified growth, perfect for beginners or long-term savers. Mutual funds offer active management for niche strategies, but come with higher fees. Hedge funds cater to wealthy, risk-tolerant investors, but demand high costs and lock-ins. ETFs provide flexibility and trendy options like crypto, but require caution. Assess your goals, risk tolerance, and budget, then start small. Research, diversify, and take control of your investments. So what's your thought on the key differences between index funds, mutual funds, hedge funds, and ETFs? Share your thoughts in the comment section below. Please subscribe to support our work. That's all we're asking, and thanks for watching.